Good morning. This is the Retired Employees Healthcare Benefits Trust, October 25th, 7:30 a.m. Looks like all three members are in attendance. I'll look to see if there's any public comment. Hearing none, we'll close public comments. Look for a motion to approve meeting minutes of July 26th.
So moved.
Support.
Moved by Michael, support by Chris. We'll go to items for discussion, and we'll turn it over to Brian Green for quarter ending September 30th, 2023.
So as I was preparing notes and kind of commentary, I was when earlier to try to find spin. I don't think spin isn't what you want to hear from your investment advisor, but try to find some theme, right?
Thank you.
Conversation around what happened, and I think colleague put it perfectly. Third quarter of this year, a lot like 22, where there was just no place to hide. Now, when I say no place to hide, go into the book, one page in, look at things from a market standpoint. Tough quarter from the standpoint of everything has a negative sign in front of it, but still well into positive territory on a calendar year-to-date basis for a number of asset classes. From an equity standpoint, it continues to be a difficult environment for fixed income because of what's happened in the third quarter and also what's happened so far here in the fourth quarter in October as rates have continued on the long end to go higher. Kind of see how this shakes out, but a couple comments that I heard this morning, Freddie Mac, quote that the 30-year fixed is now averaging 7.3%. That's the highest it's been since 2000. Ironically, that's still kind of average from a long-term interest rate standpoint. The other comment that I saw this morning was kind of looking at things from a housing affordability standpoint. And the average mortgage being taken out right now on a 30-year is 2x the average rent payment. So from a housing affordability standpoint, buying a home is more expensive than it's more expensive to buy versus rent. It hasn't been at this level since 1982. So that's when I think about like my parents buying a house and paying 15, 16, 17% interest because that's where interest rates were at that point in time. I'm always quick to point out to my dad, I'm like, yeah, that house was $20,000 though. Like that's a slightly different scenario from where people are today and trying to buy a starter home where there's, it's $200,000 or more to approach that. So as we look from a market standpoint, the S&P was down 3 and change. Mid cap and small cap stocks are down around 5%. International markets, whether you look at developed, was down 4. Emerging market was down 3. So really nowhere to hide and no big swings. Everything was down kind of 3 to 5% so far for the quarter. Fixed income was in negative territory as well. So as Mike had mentioned earlier, this kind of felt like 22, where from a stocks and bonds standpoint, there's really nowhere to hide. As rates rose significantly during the quarter, we actually saw high-quality U.S. fixed income down 3.2% for the quarter. That now puts it in negative territory on a year-to-date basis, down 1.2. That bit of a grain of salt, or I said kind of the silver lining in the cloud of the third quarter was, if you look on a calendar year-to-date basis, the S&P is still up 13%. So even in this mix of kind of positive economic news, but the bond market is signaling recession. We're continuing to see some beats from an earnings standpoint, but things just kind of seem to be leveling out as the market's traded off for the quarter. We're still in strong territory on a year-to-date basis. I always think it's interesting from a sector standpoint. The top performing sectors on a year-to-date basis continue to be growth-oriented, notably communication services, tech, and consumer discretionary. Real estate and utilities continue to be the two worst performing sectors on a year-to-date basis. Take you to page 3 in the book, talk about individual results. So I mentioned kind of trying to find a theme here and felt like 22 is one thought. And as I was working through and pulling notes on the individual strategies, the comment that I kept coming back to was like middling. Like no one really outperformed significantly, no one really underperformed significantly. It was just kind of a mixed bag of results for the quarter. We saw so overall retiree healthcare trust down 3.6 for the quarter. versus policy mix that was down 2.6. That brings us now into negative territory on a fiscal year-to-date basis, so down about 0.5%, but longer-term numbers still in positive territory. So what drove that? So as I'd mentioned, no one with significant outperformance, no one with necessarily significant underperformance. Ancora outperformed really due to stock selection in healthcare, names like AbbVie and United Healthcare. S&P 500, no surprises out of the Fidelity Index Fund. The one interesting thing was Apple was actually the largest detractor for the quarter, not because the stock was down 25 or 30%, but because it's 7.5% of the benchmark, and it was in negative territory. Edgewood underperformed for the quarter. Interestingly enough, past underperformance would be because they didn't own Apple. Not owning Apple in that portfolio, it's 13% of the benchmark, was actually a source of outperformance for them. But they were overweight names like Netflix that traded off in the quarter, ASML, and Estee Lauder. Clarkston, I will say the underperformance here was actually a bit of a surprise. They traditionally hold up when markets turn negative, but they were actually hurt by, interestingly enough, some names that had helped previously, like US Foods and Cisco, but also industrial names like Hillenbrand. Oakmark, from an international equity standpoint, we seem to be in this cycle of what helped now hurts and what hurt now helped. Underperformance for them really driven by autos. Mercedes, BMW, and Continental AG were all three of the largest detractors for them from a performance standpoint. JP Morgan underperformed for the quarter by about 4%. Some of their largest names and some of the largest names in the index, Taiwan Semiconductor, Tencent, Samsung, all traded off for the quarter. From a fixed income standpoint, hard to do a victory lap for saying we lost less money. Baird only down 0.67%, so held in really well versus their benchmark, really because of a little bit less duration in their portfolio and a little bit more exposure to corporate credit. And then Brandywine, the global fixed income manager, has a significant amount of exposure to longer duration treasuries. Their view is rates are actually going to start to decline, and that definitely did not happen in the third quarter and has not happened so far here. So the biggest driver of their underperformance was actually just owning 20, 30-year treasuries in their portfolios. Those have been hampered by rates continuing to grind higher on the longer end of the curve. So as you mentioned on the front end, Chris, yes, is there good news? Not for the third quarter. The one surprise I would say is Clarkston with that underperformance there, but they continue to be on a long-term basis, solid manager. We've not seen them put a significant amount of cash to work, so it's just kind of waiting to see what opportunities present. Trying to find the silver lining to close out, and I can't quite find it. Just not a tough quarter from the standpoint. It's down 3%. It's not down 13, not down 20, but just a kind of mixed bag of performance from managers because there was just no clear leadership in anything from a performance standpoint during the third quarter.
Do we need to discuss Clarkston? Because they've been underperforming now for a while, for the full year, and they're pretty close on the 3-year.
We go to end. So here's longer term numbers. This is page 61 in the back of the book. So all of the data earlier in the book is your live performance. This page we have at the back of the book here is the composite performance. So you may have had a strategy for 2 years, but it might have a 10-year track record. And here's where we have Clarkston laid out. Their performance, really so far this year, they've struggled. That's a 25 stock portfolio, so they will go through periods of significant outperformance and they will go through periods of significant underperformance. 22 was a solid year for them. 23 hasn't been so far. I look to the longer term numbers, on a 5-year basis, they're about 2% ahead. 7-year number kind of in line. If we'd like to, we can do a deeper dive. We remain, there's no change in team, there's no change in process. Any changes to the portfolio that they've made are in line with process and what they've done. So that's where we kind of take a step back and say, This has happened before, and they've recovered and rewarded patients. It's likely to happen again. So we remain highly convicted, but I'm happy, as a follow-up, we can pull together. Sometimes these trailing returns, right? It's all based on what have you done lately. We can look at things on a rolling basis and kind of look at 3 and 5 year time periods, as well as look at even shorter time periods. You can kind of see A, periods of underperformance from a historical standpoint, and B, how they've recovered, not only recovered that underperformance, but then rewarded that with excess performance above the benchmark.
So they don't have a number for 10 years. Is that because they didn't exist or because we didn't?
That would be because, so they have a greater than 10-year track record for the strategy when it's a separately managed account. This mutual fund was started within the last 10 years. One weakness to these charts is it could have started 9 years ago, but we don't have a 9-year column. So if it doesn't have it, right, if it started 9 years ago, the 10 year is going to be NA. But we can show you their longer, I think it dates back to mid-90s, if I'm not mistaken.
That's when they founded the firm.
Yeah.
That's a good question, Michael. The same question came up, if you remember, at the beginning of 22, because they underperformed so much in 21, which was a growth market. And then in 22, the markets were off 20%. They were basically flat. Tremendous downside protection.
Okay.
Do you know, are they still holding Altus? I know that was one of the ones that was,
They do.
Yep. I thought with the change in treasurer, we wouldn't have to answer questions on that stock any longer, but
well, because that stock's down it's down to $2 or $3 a share. And when we were talking, when they brought them in, because of that time, we were trading in the 18 to 20,
Yeah.
and that was still under their value, so they continued to buy that stock.
Yeah.
So I know they actually mentioned that was one that was actually weighing down their portfolio.
It has hurt.
It has hurt significantly. So, and then again, when we look at their fee structure, they and Edgewood are our highest expense annual fee compared to any other money managers we have. So again, just making sure that we're rewarding good behavior, and then if it's not working out for us, looking at a different strategy.
trying to pull up detail on Altice, right? On
Chris, which one is that?
Altus?
Altus.
Yeah, they're,
TICE holding.
ALTC?
TICE.
So the stock symbol,
What's the symbol?
ATUS.
ATUS?
So they're 10 years from $40 down to $2. And they started buying them. I'm not trying to take your spotlight
Yeah.
here, but they saw growth. They were in the Northeast. They saw growth specifically in the Austin area and started buying and doing infrastructure and putting in data cable and started getting very expensive. So that's where they went. They've been buying them throughout the last couple of years and continue to buy them. It has just been not an awesome performing stock. And again, in a 25 stock holding, that does weigh them down.
Yeah, it's a 2 point. So as of 9:30, it's still in the portfolio, and I'm not aware of it exiting. It's a 2.2% position. So I would say it's no longer. I would say
Yeah.
it's weighed on the portfolio, but at that level, it's no longer weighing on the portfolio. I do remember part of the thesis there was, and I thought it's kind of wild. Part of Altus's business plan was eliminating cable and shifting to just internet service, with everyone going streaming. But there was also a significant pickup in margin because they needed to provide less technical support, which I thought was odd. But they're like, it's the remote, the phone calls of the remote doesn't work, and that's a 15 to 20 minute personal conversation versus if Hulu doesn't work, you're not calling the cable company, or if Netflix doesn't work, you're not calling the cable company. It's either the internet's working or not working is a much more simple discussion. I will follow up with some more detail on both Edgewood and Clarkson that I think will help instill confidence.
Okay.
And Edgewood, was it last year when we brought them in, they talked about how the partners had actually pulled some of their own money to reinvest in them. They believed in their model, and they even put their own money where their mouth was. And
Significant amount, yeah. And they continue to, I mean, the majority of their net worth is invested not in the firm, but in the strategy. So it's invested right alongside of all of their clients. And large growth has just been such a difficult space. When you talk about Apple's 13% of the benchmark, Microsoft is 10%, like 23% of the index is in 2 stocks. And if you have any risk controls in place and are underweight that can absolutely crush your performance compared to the index.
Any other questions for Brian?
We don't need to go through any of the individual accounts because they're virtually the same, right?
Correct.
Okay. Okay. Anything else? No?
We'll go to set the next quarterly meeting based on the same schedule with the RHC and the Financial Sustainability Committee would be January 24th, 2024, with this meeting beginning at 7:30 a.m. Any known conflicts? Okay.
Other than an objection that we're talking about 2024.
Nothing I can do about that one. All right. Any new business from any of the members?
Yes, I would like to make a motion to appoint Treasurer Sostak as our new chairman.
I'll second that. So next meeting, January 2024, Michael Shostak will be the chair. And meeting is adjourned. I'll ask for a motion to adjourn.
So moved.
Support.
All right. Thank you.